Welcome to Breaking Banks, the #1 global fintech radio show and podcast. I'm Brett King.
And I'm Jason Henricks. Every week since 2013, we explore the personalities, startups, innovators, and industry players driving disruption in financial services.
From incumbents to unicorns, and from cutting-edge technology to the people using it to help create a more innovative, inclusive, and healthy financial future. I'm JP Nichols, and this is Breaking Banks.
Welcome to Breaking Banks. I'm your host, Brett King, and JP and I are in the studio today to talk about the big news, the breaking news. Well, it sort of broke last week.
Relatively breaking news.
Yeah, relatively breaking news. That Revolut has secured, provisionally at least, their UK banking license.
Yeah, step one of a two-part process. Is that how it works in the UK?
Yeah. I think so. But, you know, they can now represent themselves as a bank, at least, you know, in the mix of things. And that gives them the rights and obligations of a chartered financial institution in the UK. Obviously, they're already licensed in the EU. But this is seen as a more serious license, and it also may help them with entry into other markets like the United States. Because a UK banking license is, I guess, is given more credence as a foreign banking license in the US.
Yeah, I don't know if I didn't watch enough of the British office to know if there's a comparable clip for David Brent, but in the US version of The Office, there's a meme of Michael Scott screaming, "It's happening," and they're running out. That's kind of the feeling that's happening right now, right? A fintech challenger is officially licensed, becomes I guess we can't quite say incumbent, but a more of a symmetric competitor.
Yeah, I mean, let's look at the numbers. So, you know, they've got about 45 million customers right now. In terms of their last results, I'll just bring them up while we're talking about it. You know, their last results were revenues were 2.2 billion. That's June 2024. 45 million customers globally, and profits of 545 million, which 3 years ago would have seemed almost unbelievable. The revenue, not necessarily, but the profitability. You know, how many banks were saying they'll never be profitable? You know, the incumbents. Certainly, I heard that a lot, you know, particularly pre-COVID. Obviously, things have changed a little bit. And also the other thing, you know, to recognize is that with 45 million customers today, Revolut is bigger than HSBC's retail practice. HSBC has 38 million
And what's
customers.
the cost to acquire and serve those customers?
Look, you know, like I think Revolut's customer acquisition costs now are on the higher end. So NewBank is now at $7 per customer. Revolut, I think, is in the $20 to $30 range. It may be as high as $50 for some
still
of their
an order of
acquisitions.
magnitude less than the typical brick and mortar branch.
Right. So Chase is paying what the latest figures were, $350 to $380 US, you know, for the same. But the other thing is that Revolut can do this at scale, right? And the fact that they are at 45 million customers, which makes them bigger than HSBC in terms of number of customers and bigger than many other banks in the region. You know, you have to say, what does this say about the way, you know, digital banking is reshaping market share? Because, you know, those 45 million customers, that business has come from someone. You know, like you might argue with NewBank and WeBank, you could make a solid argument that, you know, WeBank in Shenzhen and NewBank in LATAM is a lot of their customers are net new customers because they're first-time users of banking services. It's
in
about
more
half,
developing
I think,
markets.
right?
Yeah.
Right. But you can't make that argument of Revolut.
Right.
They're operating in mature markets, and they've gone a very specific strategy with that cheap overseas, cross-border transfer stuff, a little bit of crypto. They've, and the cool factor, obviously, a better user experience. But they've got real numbers there now. They're profitable. If they follow the pattern of some of the other operators in the space, they're probably going to be more efficient at managing risk, credit risk. That's what we see for NewBank and WeBank as examples, or Alipay lending to SME businesses in China. We see significant advantages in managing credit risk because of better data models and new tech. So I see this as just, Simon Taylor, who comes on, those guys just talk about 1%, banking's 1% done. Now they talk about 3% done, I think. But, I would say that this is just more of this trend towards digitization of banking and financial services. But what do you think it means for the European market, first of all, then we can talk about, outside of it.
Well, I'm no expert on the European market, but I think when you look at, as you've noted, those are for the most part fairly developed economies with well-established traditional incumbent banks, and in fact, in most cases, a handful. And so when you have a disruptor like this of really what's an oligopoly, and it's an oligopoly in the U.S. as well, even though we still have 4,500 banks here, it's really the top 10 that have the vast concentration of assets and deposits. That's meaningful, right? That is real David and Goliath kind of things. And you talked about scalability. You think about the infrastructure, the cost basis that they have today. What's the incremental cost to add the next million customers, the next 10 million customers, the next 50 million customers?
That's the point, right? They can not automate the machinery, but it's much more scalable. And this is the thing that we're seeing. You look at NewBank in LATAM, 100 million customers, the largest bank outside of Asia Pacific now in terms of number of customers.
Massive growth.
WeBank is the third largest bank, I think, in China now in terms of number of customers. Getting close to 500 million customers there. Now you've got Alipay and WeChat Pay and so forth in the market. So, my bank is a competitor there as well. But my point is, you've got massive scale coming from these organizations. And, the argument used to be in those early days, well, the only reason they're growing so rapidly is because they're so small. But you can't make those arguments any longer, right? They're larger than some of the largest banks in the world, and they're still growing. And that's why they keep getting funded.
Well, and look at it just even from a market cap now. It's early and that could change, but $45 billion market cap. That's in the neighborhood of Capital One, much higher price to earnings, price to revenue. So certainly reflects some optimism of the upside. Maybe that'll bear out, maybe it won't. The thing I know the least about is their balance sheet. We can talk about the customer growth. We can talk about their income statement. I don't know the ins and outs of their balance sheet. And to your point, maybe they're going to end up being better at risk management. It appears maybe they are so far. But that is what traditional banks live and die by, right? That if they get the lending piece wrong, nothing else matters because of the leverage nature of the balance sheet.
Yeah, I'm looking through the results from June. I'm not seeing the NPL ratios or anything like that immediately, but I'll do some digging on that. I think that's a fair point. But I think also, it is a modality shift that's occurring because of the tech, right? And because of the experience expectations. But here's a challenge to some of the traditional thinking. I mean, if you were to think about who are the most likely candidate banks to be able to really use artificial intelligence in the next generation of their product, then obviously these digital players would appear to have a significant advantage in deploying that type of technology.
Right.
And here's the question for you is, those traditional metrics that we used to talk about, ROE, asset size, All of those things that are sort of the main ways we've thought of, who are the biggest banks in the world, the most successful banks in the world. What's asset size do to help you make the transition to becoming an AI-based bank?
Yeah, nothing to
Right?
perhaps it's even a drag on that.
Yeah, I mean, you could spend more money potentially than Revolut, but then you've got a lot more complexity in the systems that you're having to deal with. So this is really, I'm wondering whether, we can now say that NewBank and Revolut, we can say WeBank in Shenzhen, these are amongst the largest banks in the world and certainly the largest banks in their market. They're showing, continued growth. Revolut at 45 million, they put on 12 million customers last year in 1 year, right? So they've essentially, it's not, it's it's big growth, in a single year. What's the percentages?
Customers.
Yeah, exactly. Yeah. So you look at that and say, look, if they can keep that going and they can make an entrance into the US market, it's a tougher market for them, obviously, but certainly there's still growth opportunities for them in Europe, even opportunities for consolidation, maybe acquiring other banks, particularly if they IPO and they go down that route, which looks like this is what they're preparing for. It's interesting. I just think it means that, I think in 10 years' time, if you were to ask who's going to be the biggest bank in Europe, then you are going to now have to put in the playing field. Obviously, you're going to have to include the likes of Revolut and Monzo and Starling, right? And N26. And NewBank could conceivably come to Europe, particularly in Latin, like Spanish and Portuguese markets.
Well, I was talking to some bankers this past week, and we were debating some of these things, and these were all U.S. based. But what I said is, look, just directionally, do you think 10 years from now, the best, most thriving, most profitable banks, do they look more like a Revolut, or do they look more like an HSBC? Right.
No, they definitely have to look more like a Revolut, right? They have to compete, right? And this is the one advantage you pointed out, is that scalability, the scalability element where, Revolut can scale that up and, it's costing them less to acquire, but it's a machine now and it's a digital machine. So much lower friction, particularly for entrance into new markets and things like that. Whereas traditional banks, just even on the tech stack stuff, it's going to be a nightmare to think about creating a new setup in a if you've got to link it back to existing core and things like that, you just even your technical agility is going to be a question. So there's no question.
And look at their marketing spend. One of the things that's been highly correlated to their growth is marketing spend. They've spent a lot, and I think they've spent well. It appears to be pretty effective, kind of catchy advertising. So if you don't have that cost advantage, you can't spend that kind of money to win in that arms race, right? There's the digital arms race and the customer acquisition arms race. But one of the things that feeds that is the marketing. And so many banks, frankly, are not really very good at marketing.
So here's another great stat from their results. 70% of new retail customers joined organically or were referred by someone they know. Word of mouth growth complemented by further investment into marketing and sales resulted in Revolut Business onboarding 20,000 SMEs as well. So, it's pretty, I think those results speak for themselves.
How far along do you think they are in their SME business?
They didn't have the numbers there, I think.
My sense of it is that's pretty early, right? They started at acquiring customers. That's another whole driver of growth and an area that...
Yeah, so they said the company is on track to surpass 50 million customers by end of financial year 2024. So that's pretty impressive.
And you think about... We've talked about this a lot on the show and a lot of our recent guests on the fintech revolution for small business is several innings behind the consumer. And the first movers there are going to be able to leverage, again, not only the tech stacks, not only the acquisition costs, what they've learned in marketing, and really being able to leapfrog and grow a lot faster. And for a lot of banks, and particularly the smaller banks all around the world, certainly the community banks in the United States, that has been their last refuge. Well, we're going to really double down on the small business.
So one of the really interesting points, JP, you make about the whole SME business piece is we are now starting to see, I think, a significant shift in your ability to automate, business or services for SMEs. And so, a great illustration of that is Alipay using the mobile wallet feature attached to merchant activity on Alibaba to be able to nut out cash flow, right, and discern cash flow and be able to price in credit risk, for those SMEs. And we're talking about 50 million SMEs. This is 40% of the SME lending market now. Their NPL ratios are half of the biggest banks, ICBC, Bank of Communications, Agricultural Bank and so forth, in terms of lending to the SME segment. So this is a data business. Right? Their success at being able to manage risk and, seamlessly onboard these SMEs on the Alibaba platform. Yeah, you could argue it's because the Alibaba platform is there and providing funding to grow business on those platforms is a smart deal, but they've got all that cash flow data so they can see the business in operation because they're providing this platform. It gives them an enormous data advantage. And so I think when you start thinking about some of the applications of this, particularly Starling, with their SME approach and so forth, again, you could see a lot of scale there. And the commercial business, as you said, has been something that, has protected incumbents to some extent. But I would argue that's changing now.
I agree with all that. And let's go all the way back to where you started, which is providing new insights, new services, new products for that. Banking traditionally, it goes back to Ted Levitt and what he said in 1960 in his piece, Marketing Myopia, about the railroads, right? The problem is they viewed themselves to be in the railroad business, not the transportation business. And I think traditional banks view themselves to be in the banking business, not, the financial lubrication business, as our CFO likes to put it, however you want to phrase it.
Yeah.
It's something more than simply, we gather deposits, hold that money for you, and then we lend it back out as a part of the business practice. There are things around, like Jason likes to call the edge of money, and those are the edges that are closest to the owners and the users of that money, where it means more than fungible dollars and cents. It actually represents, assets or payroll or whatever it might be, and being able to understand those jobs that businesses have to do, whether that's, receivables, whether it's payroll, whether it's just getting paid from their customers, there is a lot of opportunity to improve that. And that's where we've seen a lot of growth in fintech. And when you think about those fintechs maybe now starting to get licensed, it really opens up a whole new world. Here's the other question I have for you, Brett.
Yeah, go ahead. I have one for you too, but go ahead.
If you're a bank, one of the things you may have been saying over the last few years is, well, it's unfair competition. They're not licensed like we are, so therefore they're not subject to the same, prudential regulation.
So this is similar to the question I was going to ask you, but so you're on
is this
the point.
Good news or bad news?
I know where you're going with it. Well, no. So I'll tell you my perspective on this because I think you'll find it interesting. Again, I'm going to bring the futurist lens to this, is that in 20 years, there will be no such thing as a difference between the charters, and what a bank looks like will look a lot more like a Revolut. It'll probably be a lot more technology based because of the AI. And that will be what we consider a bank. And we will have gone long away from the capital adequacy requirements and the branching requirements and those sort of things that make up traditional banking as artifact in the charter or licensing regime, because to be a good bank in that future highly autonomous smart economies of the future, you don't need any of those old things that you talk about now as a level playing field, right? You know, what you need is you need the tech, you need the agility, you need the ability to craft, you know, highly personalized, experiences for a customer of one based on, rich data sources and so forth. You need to be embedded in their world. You need to be automating, large scale systems of transactions and so forth, particularly on the business side. All of those things we're talking about, none of that is really connected to what you would call a traditional bank. And so that's what I think. I think when we think of a charter in the future, it'll be a technology infrastructure as a core part of the economy. I don't think we'll think of it as a bank in the way we think of it today.
Well, the one area I might disagree with you on is capital adequacy, but that will depend on how much you're leveraging your balance sheet as a bank, because there are so many other functions.
I mean, there's still going to be regulatory requirements.
There's probably going to be new ones, right?
Right, exactly. Yeah, like, you're going to have AI regulation come in about what AI is allowed to do. Just like you do with the SEC today in terms of a recommendation that an independent, financial advisor or something is going to give you. We're going to have same constraints on AI in terms of what they can do and so forth. There's obviously going to be mechanisms in there for what happens if it goes wrong, and things like that. I think there's going to be a lot of new
because the speed at which bad things can happen has been accelerated. We saw it with Silicon Valley Bank. We see it with, some of the trouble going on in the
deposits can move at the speed of the internet.
And some of the third-party technology. So I think that the regulations will move to meet that as well.
Well, maybe the regulators will have to become technology organizations so they can assess the viability of the technology platform.
Now I'm really questioning your abilities as a futurist. That might be a bridge too far.
Well, think about it. Let's just take AML, right? Anti-money laundering rules, and it costs billions of dollars globally for banks to be compliant with this. Surely that can be fixed by artificial intelligence. But that would require the supervisory and regulatory function to have AI component. I don't think you distribute it through every bank and make them. I think you need a broad sort of transactional AI overview. I think that's like the way we think about network security or cyber security today for large networks. I think that's how we need to think about it.
And not just AI, right? That we need to embrace a whole lot more technology and machine learning and data at scale.
Identity reform, is a big element of that, when we start talking about the fraud stuff. Anyway, we could talk about this all day, but we got to wrap. But I just thought it'd be interesting for our listeners to sort of, this conversation has been going on over the last couple of weeks now, and I thought we'd give our take on it. And anything else to add before we go?
No, more to follow.
All right, great. You're listening to Breaking Bank, so we're just going to take a quick break and stay tuned for more goodness in the fintech world.
This show is brought to you by Alloy Labs. As much as we love talking on the show, we believe that action is more valuable than talk. Alloy Labs is the industry leader in helping fearless bankers drive exponential growth through collaboration, exclusive partnerships, and powerful network effects that give them an unfair advantage. Learn more at alloylabs.com. Alloy Labs. Banking Unbound.
Welcome back to Breaking Banks. I'm your host, Brett King. We had the opportunity to catch up with the founder of TimeBank, Kuhn Yonker. Welcome to Breaking Banks.
Brett, so good to speak to you again.
Yeah, no, it's good. We saw each other in London, what is it, 2 months ago? And we caught up. But, I guess, even though you're based obviously in South Africa, and today you're in Johannesburg, coming to us from there. Tyme is now starting to expand, and as a challenger on the African continent, not only are you the fastest growing and most successful challenger in the South African market, but also you have a phygital approach, which is rather unique for challenger banks or neos, not only on the African continent where mobile money is hugely successful, but beyond, where you are in places like the Philippines and Vietnam, which is a really interesting counterpoint to the success we see for NewBank and Revolut, and Monzo and others, WeBank in Shenzhen, who are growing, obviously, all of the fastest growing banks in the world today are fintechs. So, it'd be interesting to get into that. But before we start, why don't you start with the foundation story, how Tyme came to be, and give us a bit of history behind the formation of the bank.
Brett, yes, for me, the Tyme story started way back in 2000 when I was doing my MBA, and I came across the work of two academics, C.K. Prahlad, who wrote a book, Fortune at the Base of the Pyramid, that was really around operating model innovation, and a Peruvian economist by the name of Hernando de Soto, who wrote a book, The Mystery of Capital. And I put two ideas together to come up with a theory of success in retail banking that says that if we could meaningfully change the operating model of banking, we could serve 10 times the customers at a tenth of the cost of the old banks, and at the same time give them a better customer proposition, give them a better customer experience. And it's phenomenal to look at this 20 years later and to see it happening in real time under our noses. So that passion for financial inclusion, for democratizing access to banking is really sort of the origin of the bank. I did some form of financial inclusion work in big banks here in Africa until 2011. And in 2012, me and my co-founder, Chart van der Walt, took the big step to go out on our own. We did the first years as a banking as a service business, working with mobile operators and retailers. But our ambition has always been to start and run our own banks. And that dream sort of came to fruition in February 2019 when we launched TimeBank in South Africa, which is now sort of 5.5 years old with 9.5 million customers. In 2022, we launched GoTimeBank in the Philippines, which now has around 3.5 million customers. So just short of 13 million customers all in all on the platform. And we've just launched our first product in Vietnam as our third market.
Awesome. It seems counterintuitive, during the pandemic to launch a bank. But actually, if we look at the success that Revolut and Monzo and others had, many of these banks, NewBank, did pretty well during the pandemic as long as there was funding. But, tell me about going through that period in early 2020 as the pandemic sort of hit. How was it being in the inside of this where, you were still a fledgling bank, and how did you navigate that period?
Brett, I'm actually having PTSD as you're asking me the question.
Sorry.
as the first words of A Tale of Two Cities, it was the best of times, it was the worst of times. On the one side, you can now still look at the graphs of customer adoption when you open, our sort of financial history, and you see this jump in customer adoption in March, April, May 2020. And those were the months in which South Africa went into hard lockdown. And we had this massive surge in customer adoption that continued to accelerate. That was the one side of the story. The other side of the story is that we launched a personal loan product which we accelerated in February of that year. And by May of that year, we had 80% bad debts on the book. So it was great in terms of adoption, very tough in terms of building the lending side of the business, and particularly tough for capital raising. But, having survived it, I'd say two great things came out of it. The one thing is that I think the business today is way leaner than it would have been from a cost efficiency perspective and from a culture of frugality perspective than we would have been if it wasn't for those tough years in COVID. And the other thing is, I think that we've proved to ourselves that we can survive tough times and that we actually can thrive through tough times. So what Nassim Nicholas Taleb refers to as an anti-fragile business. It feels to me that COVID taught us how to build an anti-fragile business.
Yeah. I mean, I think there were some fundamental elements, the digital adoption and so forth. But, let's take a step back. For those unfamiliar with the South African market, what's the regulatory environment like for a challenger like yourselves?
Yes, I would describe the South African regulator as progressive, but risk-averse when it comes to granting new banking licenses. So South Africa doesn't have a digital banking regime and is very strict on people attempting to do new bank-like activities without a banking license. So in South Africa, we run on a full commercial banking license and need to comply fully with all requirements of full-scale commercial banks. And we one of only 3 banks since 2000 who have been granted banking licenses in the market. One way to think about the South African environment, it's still an oligopoly dominated by 5 banks. Now 6 banks, including us, who hold 97% of all primary accounts in the market. We hold about 10% of that now. So very good profitability in banking and very sophisticated players with I think, very good quality customer service generally from a traditional commercial bank perspective.
Yeah, because, previously we have seen, for example, with M-Pesa's entry into South Africa and the deposit requirements being a lot tougher, that, it didn't go as smoothly there. That we saw with mobile money in Kenya, for example, or Nigeria, although Nigeria has a very similar deposit taking requirements to South Africa.
Yeah.
But, one of the things that we've seen, obviously recently, we just saw the results of Revolut. And Revolut had some phenomenal growth. It was at 97%, revenue growth year on year. We see NewBank with incredible growth, now out to, 105 million customers, and their market cap is well ahead of Itaú, the second largest bank in the region. But, one of the things that's notable is you have bucked the trend a little bit in that you do have a phygital model. You do have physical presence in the market in South Africa, and you've replicated that certainly in the Philippines where you've gone. But having run a challenger bank myself, I find this a little counterintuitive because, the whole scalability element comes with digital onboarding and digital engagement models. So talk me through why, is that a regulatory requirement, or is this something that you feel is, a differentiator in the market? Because your growth, getting to 10% market share in just such a short time is phenomenal. So where does that fit in the strategy?
Brett, we can speak the whole hour just about that. And I would say the first thing I would say is that these models are very contextual. I don't think I would ever try the model with Movin in New York or with Revolut. Interestingly, there might be an argument for the model in other emerging markets like Mexico, but maybe worth to just very briefly describe what we do and then
please. Yeah.
So we actually have two deployments in the physical world. The one is that we deploy digital kiosks that are largely used for customer onboarding and customer servicing in physical retail stores. So imagine clothing and apparel retailers, grocery retailers having these digital stand-up kiosks in the store where you can open a bank account in 3 to 5 minutes and it issues you a physical debit card. And what we do is we employ field marketing agents in combination with these kiosks. And their job is really to educate people about digital banking, show them how to open a bank account, and help them with the first steps of adoption, which is download the app and go to the checkout counter to deposit physical cash notes or coins into your bank account. And that's the second channel we have. So you can think about the kiosk as sort of replacing the sales and service function of a branch and the checkout counter replacing the cash management function, the teller function of the branch for cash in and cash out. And that second channel is actually well known in places like Africa and Southeast Asia, where cash is still dominant. Now, this channel has proven to be a big winner for us on three fronts. The first is, and this is very counterintuitive, our cost of customer acquisition is actually brought down by this channel. And the reason is that it's a very cost-effective channel that reduces the need for digital marketing to build trust with customers. So our CAC is around $4 to $4.50 across our markets.
That's phenomenal.
Compare that with NewBank at $7, Jargo at $6.50, and the US banks and the European banks much, much higher than that.
Oh, yeah.
So as far as we know, Brett, you probably will know better. As far as we know, $4 is a world-leading CAC.
We bank in Shenzhen is lower, but but that's sort of an exceptional market, Yeah, in the West certainly, yeah.
Yeah. So the first is very low cost. The second is that it accelerates trust in the brand. And so by putting these kiosks in well-known retail stores, associating the brand with the loyalty brand and the retail brand of retailers has helped us accelerate our path to becoming a primary bank and to becoming trusted by customers. And then the third is that what we do is we integrate the banking proposition into the shopping proposition through integrating into loyalty, buy now, pay later, and so on. And that actually gives customers this very, I would say, seamless set of nudges or hooks to initially adopt the product, to drive that initial use cases and adoption. And so it's worked extremely well for us. I think that it is a very good model for segments of customers that aren't sort of digitally native or are not early adopters, not comfortable with digital, to get them on the digital journey. But what's interesting is that a smaller and smaller percentage of our customers is coming to us through that channel. So in the early phases in South Africa, 85% of our customers have come to this channel through this channel. In the Philippines now, only 55% of customers come through this channel. So we are seeing this move towards more and more customers feeling comfortable adopting our proposition through an app download, a pure digital journey. And so increasingly what we see these kiosks as is more like brand building and education points rather than the only channel that will drive customer adoption and scale.
And so for ongoing engagement, do you see that sort of improves that conversion through to digital and confidence in the digital channel?
Undoubtedly. So, and I think the key to that is not so much the kiosk as that first engagement with our brand ambassador, which is just creating that human-assisted initial engagements that get customers on the digital path. What we do though is once the customer adopts the digital channel for one thing, we invest quite heavily in our recommendation engine to drive digital usage, and we limit the after-sale use of the kiosk to the minimum. So we don't want the kiosk to become a dependency for the customer where they come back and do day-to-day engagement through the kiosks. So largely the kiosk is only used for customer onboarding, for card replacements and PIN resets. And particularly in markets where plastic is still used, the kiosk has the added benefit of being a really low-cost way to distribute debit and credit cards.
That's interesting. Now, in the Philippines market, of course, we have Paymaya and GCash, particularly for the remittance market. People are very comfortable with mobile money transfer. And, of course, on the African continent, we have MTN Money and, and M-Pesa and others really getting some traction there. So how do you envisage the whole mobile wallet space impacting, Tyme's strategy over the next few years?
I'm an avid reader of your predictions about what will happen to these things. And I'm pretty much coming out in the school to say that I don't think for customers there's fundamentally that much of a difference between a mobile wallet and a bank account and a crypto wallet and so on. It's a store of value. And therefore, one has to make sure that you're able to compete head-on with both the wallets and the more traditional bank accounts. We do think, though, that there is a brand positioning benefit in being a bank from the perspective of being able to be called a bank, the trust that comes with that.
Sure.
Obviously, the trust has to also be combined with very robust systems and continuous uptime and so on. But we do see already, for instance, in the Philippines, that through the fact that we've concentrated our efforts on 99.99% uptime, we're already creating for ourselves a reputation as being a very robust store of value. And we think that there's an opportunity for us to become the more natural candidate for people to pay their salaries and to use for larger payments and so on. And then if you can add to that slightly more sophisticated savings propositions, you can add to that the lending propositions and so on, we still think that there's a way in which to differentiate ourselves from that trust perspective, also from the perspective of being the guardian of the customer's identity. And this is where the kiosks, again, help us, because in some markets, it's the only place where we can actually collect the customer's form factors, identity form factors, facial print, their fingerprint, and so on. And that puts us in a very strong position to become, over the longer term, the entity or the company that validates the customer's biometric identity.
We've also seen, particularly with the mobile money stuff and what we've seen with the mobile wallet plays in China in particular, a lot of network effect, particularly for family members and things like that. So talk to me about, because your growth has been phenomenal, clearly, with the market share you've got in South Africa. And the other element I'm interested in is the contextual piece, right? So, particularly with the success we've seen for BNPL, more recently, and the fact that you do already have some integration into sort of the retail sector, how do you see those two things, or how are you playing them in terms of contributing to growth?
Yes, the interesting thing that we see is that if you can launch a product that the customer experiences as contextually integrated into their life, into their environment, it makes it just so much easier to land that first one or two or three use cases. And for us in South Africa, BNPL is quite an important part of that story. It is not a big profit driver for us, but it is a very big driver of that first that first experience and opening the customer up to the idea that I can do both my savings and my borrowing in one place in this environment. And so, again, our school is that we think that the long-term game is not to be single use case players or limited use case players. The long game for digital banks is to become full service retail banks and full service SME banks. And we play in both those segments, retail and SME. And it's really the interplay of different products and over time becoming a one-stop shop for customers' everyday banking needs, where we think the game will be at over the longer term. Having said that, I think one thing that we've learned the hard way, it's better to do few things well than to do many things mediocre way. So we are patient in building out that full retail and SME value proposition over time.
All right. So the obvious question that sort of would come up in any conversation about building a bank today is the role that AI is going to play in TimeBank. So talk to me about, where you're investing in that and how that's changing your strategy in terms of that sort of full service approach.
Brett, it's very intimidating to talk to you about this product, about this topic. So I will stick to my knitting and share some of the more obvious use cases that we see. The approach we take is we've got sort of a long list of over 100 use cases for AI right now. We prioritize them in terms of ease of implementation and productivity uplift. We think at this point, the low-hanging fruit is around productivity uplift and customer experience uplift. So I'll give you maybe the example I'm most proud of is implementing a combination of different AI models in our social media team. A year back in South Africa, in terms of response rate on social media, we were the slowest in the market. We have 7 people in our team compared to over 100 teams in our most direct people in the team in our most direct competitors. And we've done 2 simple things. We run AI to prioritize messaging, to figure out which messages are the most urgent to answer. And then we do essentially a first response through AI. So we just get the first response done. So we turn our 8 social media agents into editors rather than writers. And we haven't seen the industry results yet, but we think we've gone from the slowest to the fastest in 9 months through that and not adding any social media agents. And I think there are dozens of use cases like that that are not rocket science that will impact whether it's call center, whether it's text, message responses and so on. All those areas are affected. The other area where we already see very significant uplift is in the programming, in the coding area. We employ about 400 engineers and developers in Vietnam. We now have about an 80% adoption of Copilot type solutions in that environment. And we see that the productivity uplift is around 40% at this point, and we can see that speeding up. So certainly in those 2 environments, I think it's obvious that it's already working. What I'm really interested in is this question whether we can develop from putting a bank in a person's pocket to putting a personal banker or a private banker in a person's pocket. And we might be closer to that than people think.
Yeah, no, I agree. So, to wrap up, because we're running short on time, but maybe tell us a little bit about where you're at in your funding cycle and what your plans are for the rest of the year for TimeBank.
Yes, so we're in the middle of our Series D capital raise. We're raising about $200 million now, if all goes well, before the end of the year. The job of that money is to get us to profitability in the Philippines and accelerate our growth in Vietnam, and also fund the first step of our entry into Indonesia. We've committed to our shareholders to being ready for international listing, if all goes well, New York listing in 2028. So I think maybe another round of capital raise or another 2 rounds, and then if all goes well, we can be ready for public markets.
That's fantastic. Well, I might have someone for you in Indonesia, actually. So let's take that offline. But for now, if people are interested in following the story of Tyme, or sort of reaching out to you or following your work with the bank, how would they do that?
They're welcome to connect on LinkedIn or jump onto our website. My details are on there, and me and the team here are ready to connect where it makes sense.
And what's the URL for the website?
Tyme.com, Tyme.com.
Right. So that's fantastic. Well, listen, it's been great to have you on the show. Please keep us informed of your progress. Already phenomenal progress, taking 10% market share in just the space of a few years, now expanding offshore. It's really interesting. And I wish we had more time to talk about this, but maybe next time, that you've chosen, instead of expanding in the African continent, you've chosen to go to the Asian emerging markets, and certainly Vietnam, Indonesia, Philippines are all very exciting markets when it comes to this space, and underrepresented in terms of challenger banks in those markets, and yet very strong mobile money support and things like that there. Like where I'm in Thailand, prompt pay on the QR side, Vietnam with mobile monies going big time. In the Philippines, of course, mobile remittance business. So all very interesting to have sort of digital action. So a really, really interesting model, and certainly challenges some of the concepts of how NEOs should be working in this space. So I applaud you for the success you've had.
Thank you, Brett.
Keep us in the loop. But that's great. So that's the founder of TimeBank, the co-founder of TimeBank, Kuhn Yonker. If you want to check them out, go to www.tyme.com and check out what they're doing outside of South Africa as well. But really interesting progress there. That's it for another week of the world's #1 fintech podcast and radio show, Breaking Banks. This episode was produced by our US-based production team, including producer Elizabeth Severance, audio engineer Kevin Hersham, with social media support from Carlo Navarra and Sylvie Johnson. If you like this episode, don't forget to tweet it out or post it on your favorite social media, or leave us a 5-star review on iTunes, Google Podcasts, Facebook, or wherever it is that you listen to our show. Those actions help other people find our podcast, and in return, that helps us build an audience that can be supported by sponsorship, so we can continue to provide you with our award-winning content every week. Thanks again for joining us. We'll see you on Breaking Banks next week.